As Web3 and crypto mature, there's likely going to be an increased demand from both creators and users for insurance. You know, the thing you pay monthly for your car, home, apartment, even for your life with life insurance. Insurance is seemingly a natural part of any sector's evolution where there's a lot of money being exchanged for the sale and purchase of goods and services. And even in a landscape where we're told to verify, not trust, insurance will play a unique role to ensure that all parties moving forward are doing their due diligence to cut down on negligence and improve the space as a whole. On this episode, I chat with Kyle Butler about his professional trajectory into insurance and how he's excited to leverage his Web2 understanding of the insurance industry to better Web3 and crypto for everyone involved. I'm Jarrett Carpenter, and this is More Than Blockchain. Kyle, welcome to More Than Blockchain. How are you?
I'm doing excellent. How are you doing, Jarrett?
I'm doing super well, and you're down in sunny Florida, is that right?
Yes, sunny Tampa, Florida. It's beautiful, but it's still hot. I know we're in the middle of August, but it's about 96 degrees today.
And what's the humidity? Because the temperature, I have a buddy who's in Arizona right now, and he tells me temperature, but it's a dry heat. So what's the humidity? Because that's the killer, right?
Here right now, honestly, today would be about 89%. It doesn't look like it's going to rain. On days that it does rain, it truly gets up to I've seen 95% humidity indexes before.
And then the real feel is what, 1 billion degrees, like next to the sun?
On average, during the July to September months, it really does feel about 100 degrees everywhere you go.
Are you from Florida originally? I don't think
am.
we've actually talked about that. Okay.
I grew up in Orlando, so a little bit more north of Tampa, but just as hot. I mean, it's excruciating in the big city.
But it's almost kind of perfect though, because what we're going to get into today is how your insurance career, I think, is going to slide perfectly into where Web3 is and being able to insure Web3 digital assets, essentially. But I say it's kind of perfect that you're from Florida because, as we've talked about, I think we talked about off recording, Miami, Tampa, just the entire southern part of Florida is totally into crypto. And people are moving there by the droves. And a part of this, I think, is taxes. Part of this, I think, is culture. Part of it, I think, is weather. And part of it, I think, is you want to be where the stuff is happening. So I've kind of set you up there, but maybe you can talk to us a little bit about your insurance career and then bring us back into digital assets, crypto, Web3, and all that stuff.
No, absolutely. And I agree with your sentiments, and I'll touch upon why some of the reasons I think Florida is so appealing for so many projects, so many protocols, so many venture capitalists that are interested in dabbling into Web3. For me personally, I got into the insurance field because I was in business sales prior to this that was adjacent to insurance. I work for a company called Paychex, and they are a payroll, HR, insurance, and kind of all-inclusive provider for small to medium businesses, outsourcing those particular fields. Of course, not every single small to medium business has the ability to afford an entire HR department. So that's why companies like Paychex and ADP kind of fill that role. I learned a lot about insurance during that time because a majority of the issues were all surrounding either workers' comp, health insurance, a combination of both, or looking to move off of what is called a PEO into a more cost-effective solution. So I learned tons about insurance. And in Florida, workers' comp is extremely convoluted, unlike very many other states. And it's also mandated here in the state of Florida. If you have more than 4 employees, you must have this particular insurance. So that kind of makes things a little more complicated. You're going to have to be a lot more of a business know-it-all and not just a particular HR generalist, if that makes sense. As I went through that time and learned everything there was to know about how the payroll actually intertwines with the workers' comp, and ultimately how we go about reaching out to insurance brokers to provide those solutions, I realized I was very, very good with the technical acumen of insurance and business solutions holistically. Eventually, I had a lucrative career for about 4.5 years at Paychex and decided to move over to being a full-time insurance broker. Ultimately, that's what landed me here at my current role, which is Baldwin Risk Partners. We are a publicly traded brokerage. You can find us on the NASDAQ ticker tape BRP. And what we do is what's very unique is they have the exact same approach that Paychex had about holistic business mentality to solve multiple different silos within a founder or owner's business, only from the lens of insurance. So where they built their name was having an HR department, a private risk department, and then a commercial risk department, and looking at how they all intertwine amongst each other. Businesses are constantly looking for a benefits package. Businesses, of course, need physical property insurance, liability insurance, workers' comp insurance. But then how does that impact the owner who's potentially an LLC and passing that right on through into their personal tax? And then what impact does that have to the personal assets? And so we kind of take these silos and look at them holistically and say, does one impact another? And if they do, how can we help give you the best safety net layer that would make the most sense for your private risk as well as your commercial risk? And that involves our quality connections with our carriers, our opportunities to learn much more about the private risk and ultimately what assets that they have, and then how do we intertwine some solutions on the private side that mirror the solutions that we're doing on their commercial side. So that leads me into how does this pertain to Web3? Ultimately, Web3, not that it's newly emerging, because I believe Web3 has really existed since 2008. At least Bitcoin has existed since 2008. I think the first iteration really hit in 2012. And then the second wave was 2016. And now what I would call this is third wave iteration of Web3. What really sparred me to understanding the need of insurance, specifically commercial insurance for Web3 ventures, was watching the people get sold. And I believe it was December, maybe even November of 2021, the Beeple was placed on auction through Christie's. It sold for a exorbitant number, but with the Beeple being sold, I realized they're selling a tangible asset through a tangible auction, and yet neither brand had any way of insuring the tangible digital asset. And so I really started diving deeper into understanding, is it indeed true that these organizations, ventures, DAOs, and then, of course, the traditional LLC that is representing a Web3 or blockchain venture, do they truly not have commercial insurance? And as I went through my time tapping into insurance carriers, tapping new insurance brokers, reaching out to particular ventures and kind of picking their brain on what they currently have in place, the answer was shocking. 2% of all blockchain ventures and digital assets that exist on this world to this current date have a layer of insurance. And so 98% of the liquidity, the capital that we're seeing in our markets, the particular digital assets that we see, whether they're held privately or institutionally, only 2% of them have a layer of insurance. And so what I decided to do was take a Web3 approach to building commercial insurance from a commercial insurance broker that is considered probably a little bit more TradFi. So I started reaching out to individual blockchain ventures and owners and having them tell me their story. Tell me what your operation is. Tell me what your vulnerabilities are. Tell me how often that you've had to use your treasury to pay losses, and let me navigate a narrative behind why your particular industry is not only not as volatile or dangerous as one who maybe doesn't have as much information would think, but in combination with giving me the ability to work with underwriters to actually provide a layered solution for the vulnerabilities that we're seeing. Ultimately, those solutions that we saw were directors and officers, errors and omissions, liability, of course, general liability, and then the biggest one, in my personal opinion, cyber insurance liability, where we can't solve the problem of outsourcing to a cyber liability company or putting in a proper protocol into an encryption, maybe even an MFA. The only other answer is for us to bring in insurance capital for those gaps.
Can you go through those four ways or the four? I'm not
Vulnerability?
even sure. Yeah, can you break those down and give an example for each? Because I
Absolutely.
think for most people listening and myself included, insurance is just something we know we need, but then the depths of insurance, that's really why you're here today. And if you could break down those four and give an example, you can give a real world example. When I mean a real world example is a non Web3 example and then a Web3 example. That would be phenomenal.
Well, let's start with one of the biggest glaring ones, which is directors and officers. So, perfect example, traditionally, directors and officers insurance is protecting the board members from decisions that they make, whether inherently good or bad in terms of running their organization. Of course, if they're making bad decisions, that could equate to shareholders being disappointed and then ultimately drawing up a lawsuit. As those lawsuits are drawn up against the board members who take liability for their entire publicly traded company, this policy steps into place. It helps provide the legal team that is going to go into court and work through that particular law case. And then if there is a judgment, the judgment typically comes from the limits that have been purchased in that particular policy. So they have the safety net layer of if $1 million is awarded, it's already covered in the limits. And then in between that, the actual legal counsel is already covered inside of that policy. It happens actually significantly more often than you would think, especially with publicly traded companies. I mean, people have a right to, for any reason, you could actually be making profitable decisions and one of your shareholders just simply doesn't agree with the direction of the company, or it could be, of course, in the climate that we're in today, politics could always play a part. Someone decided not to respond to something. Someone decided to respond to something under the connotation of a publicly traded company. And one of their heavily invested shareholders doesn't agree with that line of sight and easily could draw up a lawsuit. So that's really what that product does for publicly traded companies. There's a lot more facets to it, but I don't want to bore everyone. I'll keep it very surface level. Secondarily, for a Web3 conjunction, why I think that is so important is because when you really think about what a DAO is in effect board members, specifically the ones that have governance tokens. I'm not trying to equate the entirety of the DAO in your community as being members of the entirety of the DAO. Only the members that have the authority to issue governance tokens and to override some of the smart contract functionality that they've set since inception. And ultimately, if we look at them as board members, then we can easily equate the liability of lawsuits that could be brought into action from either the community members as a whole or third-party investors. We're thinking private equity, venture capitalist, or even your angel investor. And so we believe that this product can solve a lot of those problems by bringing in the layer of capital that directors and officers is going to afford them in terms of the limits that they would be able to purchase. Ultimately, it's going to have the same functionality. If they're drawing or getting engaged with lawsuits, this product is going to step in the middle and provide them the legal counsel that they're going to need, walk through the particular court case. And if a judgment is awarded, of course, that's what their limits are for. Let's imagine they have $5 million limits. Of $1 million awardation. Now they have $4 million limits for the balance of the year after that particular million is paid out from the insurance policy. I think that really the hottest topic would be cyber liability. Cyber liability insurance really is fairly new. Honestly, it's less than a decade old in terms of just being openly accepted as an insurance policy that is needed across the board, whether you're a small hot dog stand all the way up to your publicly traded companies. What we're noticing, though, is you would think as a layman, okay, of course, everyone wants to target Walmart, Home Depot, the Lowe's of the world. But what we're actually seeing is small to medium-sized businesses being targeted with ransomware attacks, malware attacks, and ultimately ways of them corrupting their system or holding specialized data, whether it's PII, PHI, PCI. They're finding ways to capture that data and then hold it for ransom until they cough up the ransom amount so that they can release the particular sensitive data that's been captured. A perfect example is, shockingly enough, it was a hot dog stand here locally, a hot dog stand. Same thing. He got into his CRM database and he was using a conjunction of CRM mixed with a Square software as well as like a menu template. Ultimately, it blocked him from all of his menu items, his particular ingredients for each menu item, and it actually prevented him from being able to reorder from his suppliers and vendors. What's shocking is These particular bad actors are not just your run-of-the-mill individual who's sitting in a basement somewhere in a different country, just hacking everything they can get. They are full-fledged operations. In this instance, he had to call a 1-800 number and negotiate with the bad actor his price for them to release his funds. They even had a call center that answered the phone. Hi, this is ransomware 123. How may we help you? Have you been attacked by us? You have? What was? And then they go through the process for him to have to spend the money to get it released. Long story short, it cost him about $200,000, and he didn't do it for about 3.5 months. The average net loss that he missed from those 3 months refusing to just simply pay the ransom almost put him out of business. Now, luckily, he was able to recover. Now we've installed the proper cyber insurance liability policy for him. And if that were to happen again, the cyber insurance would pay out, cover the ransom, let him get right back to business operating status. Ultimately, this translates immediately to Web3. I think that's kind of commonality. And what I really want to impart is it's not really translating to Web3. It's the aspect that a majority of Web3 still has to be built through Web2. There's always going to be an intermediary of a Web2 website on your front-facing websites, URLs, before they get into your particular wallet and then your Web3 website. And what we're noticing a lot is clickjacking. What's happening is these companies can superimpose your website right there on your OpenSea. And I think I'm clicking press to mint, and I'm actually clicking somebody else's website that is mirrored and looks exactly like your marketplace and your particular mint. And the minute I mint it, I've actually opened my wallet up for bad actors to empty it out in real time. And so this is where cyber insurance is going to come into play, because not only is it going to come into play because it's bringing capital, but it's going to force our project makers to work with me and the underwriters so that we can identify where those other vulnerabilities are. Where are you not building the proper cybersecurity protocols? And we're going to identify them. And if they don't have a solution internally, maybe the front-end developer cannot build said solution, that's where we introduce our network, which is cybersecurity firms that can fill in those gaps and make their project that much more secure. I think if the community is going to support and pour their own hard-earned money into a particular project, we want our project makers to make sure that to the best of their ability with due diligence, they're doing what it takes to protect their particular assets, especially before they get to the end user wallet, specifically pre-mint. And I think that's where this particular insurance line item can really land for our founders, project makers, and even the VCs who are funding these particular projects.
One of the tough things I think with cybersecurity is, and I'm sure that there's a name in the industry for this, but it's like you can insure. The way I think of cybersecurity is like a home. You could have cameras, you can have these sensors that, shoot bullets out if somebody walks by. You can have all of these things. But if the owner of the house decides to leave the door wide open, what do you really do? And my point being phishing attacks. So like the one that you kind of outlined, it's almost like, and I know two people, and I'm not going to shout their names out here, but I know that they've been phished and they've lost NFTs, right? Very valuable NFTs. And this has nothing to do with their knowledge of the space or any of this. They literally just didn't know that the website was spoofed or was copied, as you're saying. And so how does insurance play a role there? And is the insurance that you're talking about, I mean, at some level, it's just kind of like, okay, this was your fault, I'm sure, with the insurance. But is the insurance that you're talking about, if we're talking about NFTs, is it for the companies that are offering the mint? I'm assuming it's not for the individuals, right?
We have hopes that down the road we can eventually find a solution that can insure the individual's wallets. But right now, the products that we're talking about are from the commercial side. It's really to protect the projects and project makers of those bad actors. Now, it does kind of intertwine. It's not necessarily replacing someone who's an individual community member and they went on the wrong Discord and their wallet gets emptied. The insurance is not really going to cover that action. But what it will cover is if someone is superimposing on our project maker's website and they've done their best to prevent these type of bad actors to superimpose a clickjacking protocol or to have the ability to drive traffic with a false link on their Discord. If they've done their due diligence and we've gone through what our requirements would be that would equate to due diligence, absolutely, these policies are going to pay out. Ultimately, what the insurance policy is really there to do, it's any gap that you cannot financially outsource yourself with another physical solution that exists, whether it's a white hat search or outsourcing to do smart contract review. Like those things are tangible things that we can actually put into action today that wouldn't require insurance. If you unelected to do a smart contract review, perfect example, Akatar's smart contract issue a couple months back. Ultimately, his community, their community, I shouldn't say he, that their community had reached out numerous times and said, we noticed a bug. Will you please do a bug bounty? Project owner said no, and they allowed them to move forward. Instantaneously, the contract locked the founders out of the digital assets. The end users did not receive the digital assets in the mint, and the money was in essence lost in cyberspace, really, till this day and probably forever. That might not have been a covered breach, only because in that instance, they should have done the bug bounty. They did not do the bug bounty, and we can't replace negligence. But let's imagine they did do that bug bounty, and we have it certified that the bug was not actually going to impact the mint, and then the mint still occurred in error. There is absolutely an insurance product that could help, not necessarily make the entire project whole. It probably wouldn't replace the entire $120 million that they lost, but it will replace a portion of that number so that they can rebuild. Now, ultimately, Akatar's rebuilt within 72 hours. They re-released that mint. So their treasury already spent the money to cover that loss. I mean, they ate the loss in completion, spent the money, emptied the treasury, was able to burn some more tokens and be able to rebuild their project. Insurance is going to provide a layer in between that entire rebuild that's going to give them the capital that they need so that their leg is one step above the competition who may be emptying out their entire treasury. Now, if we get into the really dangerous stuff, we think about what's going on with Voyager being made to pay back 175 million to your end user wallets. That probably wouldn't have been an insurance coverage, but I don't know the specifics on what they infracted with the eyes of the government, who are forcing their hand to pay back their particular individual wallet holders. That's why it's so important for startups and huge protocols to be tapping into individuals like me. I know I'm rare. There's not a bunch of us talking about this, but as the familiarity grows and as they have the opportunity to reach out to a risk manager, that's what I live and breathe every day is, well, what angle does it look like so that I can make sure that it falls under the parameters of what your insurance is actually covered. And if you don't have insurance, let's install the insurance. As we're going through that process, we're going to discover those particular vulnerabilities and we're going to know it ahead of time. Now, of course, if I'm making impartial judgment to say, I really think you need to do a bug bounty and they still refuse, that is their prerogative. That is their right. They can do that and it could inherently have a problem. But if they follow our directions, my job is to make sure they're not making claims. So my vested interest is making sure that every protocol and solution that we can put together actually stands the test of time and stands there when the vulnerability is attempting to be breached. It doesn't behoove me to let my projects have to make claims. It only behooves me to help them make their projects so secure that hopefully they never use the product that I'm particularly selling to them. Does that make sense?
Yeah, I mean, that makes perfect sense. Every time I travel abroad, and depending upon where I'm going, if I'm going to a place that I've kind of never been, and I travel with my mics, I have my cell phone, I have my laptop, couple $1,000s worth of equipment, I normally insure it.
Yeah.
And it's like 80 or 90 bucks for 2 weeks or whatever. And that's just the what if, right? That if something were to happen, I know I have an insurance company, this global insurance company that, will protect it. They're really great for video makers or anyone who's doing content who's carrying a bunch of electronics just in their backpack. And it's always in the event of the what if. I mean, anyone listening to this, wherever they're living, there is insurance on that house for fire or flood, depending upon where they are. And that's obviously, like you're saying, in the event, like you do not want that to happen. But if it does happen, that's where the insurance plays its role. And one of the things I want to ask you is, in the past, I was looking at doing some trips down to Latin America, and the company essentially went under. When COVID came, that company was gone instantaneously. But I remember having many hour-long talks with this insurance company in Denver that I had been kind of passed on to, referred to, I should say. And they were talking about how what I wanted to do was, not a lot of people do. It's like bringing people, to different countries. It's just kind of like weird. And they were saying, we had to go through how much time people were going to be in the car, how much time people were going to be in transit, what were the roads like, what was the safety, because they had to go essentially and do their own risk mitigation assessment, I'm assuming, to create this particular product for my use. So my question for you then is, I'm assuming there is no one-stop shop thing. Every single NFT needs a white glove kind of bespoke love to it, where you are going to look at it and say, okay, these are where you have liabilities. This is where you don't. These are where we're going to, you're talking about this bug bounty thing, which I think is probably analogous to a home inspection. You can choose not to do that, but then you're opening yourself up to things that maybe you can't see, the known unknowns, if you will. So are you anytime, if there's an NFT project that's listening to this and they're like, wow, Kyle knows what he's talking about, I want to go talk to Kyle about our project. Is this something where you're going to, you're going to have to do a bunch of intake and then create an individual product right now for each one?
For the most part, the answer is yes. Each time, at least in terms of understanding the vulnerabilities of that individual project. I mean, an NFT mint is much different than Clearpool and a DeFi protocol that is becoming a liquidity pool. Does that make sense? And we have completely different vulnerabilities, although some of them are very much intertwined. When we think about the true nature vulnerabilities of Web2 in general, and cybersecurity breaches, those kind of stay consistent. But then as we get a little bit deeper, who has access to what? And that's really the biggest vulnerability is, and especially in the decentralized model, how do we get our founders to have a layer of control over the actual digital equipment that is all over the world? When I have front-end developers in Canada and I have back-end developers in Argentina, how do I actually make sure they're doing the MFA that I've required them to do? Are they making sure they're not opening emails that say they're from me, Bob Iger, but it was not from Bob Iger? It was actually from Igor in Slovakia, and he's looking to empty your wallet. So how do we get those standards across a decentralized model? That's why it really is a one-on-one basis. Doesn't mean that the process is going to take 90 to 120 days just to get them a quote or an answer on what it would look like. But it does mean we do have to have a little bit deeper dive on what is the actual specifics of this particular project. And that's very similar, especially as we get into complex risk for any really middle market and enterprise size company. There's really barely any company that we particularly do business with in our main street that doesn't need that type of white glove service. I mean, there's a big difference between what Hertz is doing and a company that is delivering paints but does have a 5-vehicle fleet. And to your point, because you rose a really good point with the house analogy, I think the best way of describing it is, if you refuse the inspection and you did not notice there was black mold, we can tell you with this certainty there is no coverage that is going to include black mold after wiping away the inspection period. So when you go to purchase your homeowner's insurance and you chose not to take a look at the danger, that's already excluded. Now you go up into your attic on a weekend and you're just trying to look for your leaf blower and you discover that Mount Vesuvius is growing under your AC unit. It's a problem and it's not included in that insurance. So that's why due diligence is really important in any facet of business. You really need to understand the legal and liable ramifications of where you're stepping into, especially when you think about the little bit of precedent that we have towards DAOs. I think I'm not an advocate for or against DAOs, but I really think that our audience needs to understand fully what they are joining when they choose to sign their name and become a member of a DAO, and what liability really inherently is there by participating in this type of corporate structure. And I honestly believe that every single one should contact an attorney specifically an IP attorney that understands at least the notion of Web3, so they can give them the proper guidance that maybe they should create a holdings company on the side. Maybe they should find a way to become an LLC or a C Corp or an S Corp, because that is providing the layers of protection versus being completely exposed as an individual. That's what you don't want. You do not want to open up a business and it's your own mortgage and house on the line in terms of liability for the actions of your business. And they have to tap into the resources around them to understand those ramifications. This is a very complicated subject matter. Nothing about crypto is easy. If it was easy, we would already have full-on adoption. Would you agree? They think that it's akin to Beanie Babies, but I say that it's more akin to 1992 when we're all building different versions of Netscape versus AOL versus Yahoo versus Google. That's what's actually getting built here. And if we think about the complexity of what Silicon Valley created with the tech bubble, this is a new iteration of that. And that's why we have to take the vulnerabilities and our responsibility as project makers seriously, because what we don't want to happen is the bubble burst due to lawsuits. That would be the worst bubble burst. If we build it and the mainstream just does not appreciate it, the capitalism doesn't exist because the market demand isn't there, I think we can all accept that. I don't think that's going to be reality, but we can accept that. But if we build it and disruption happens and dysfunction happens and a majority of the investors lose their money due to wallet inaccuracies or dumping of wallets or bad actors hacking the entire project or rug pulls, the connotation of what really I believe the Web3 ethos is loses its staying power. And ultimately, we need to build trust. It's a trustless society where all we're doing is building trust. The antithesis of anything we've ever thought about before, and yet it works. Most of Web3 is IRL discovery and interactions that bleed into online interactions such as this. Does that make sense?
It makes perfect sense. And I talk to people all the time that Web3 for me is more about the IRL, even though everyone thinks it's about the online. And I'm like, no, the only reason why I want this NFT, like I just bought a calf lions, which is tied to Lion's Milk in Brooklyn. And if you're ever up in New York, you should check it out. It's an NFT cafe. If you go, you get 15 or 20% off. No, 15% off if you show your NFT. You basically just open up your MetaMask, and they have screens all over, and you can put up your NFT when you're there. And so I got a calf lion because it gives me access. I think they have an Airbnb apartment that they have above, but now I have access to that. There's just like a bunch of different access things, but the only reason why I own that NFT is my utility is in real life things. And I want to go right there into your time at Permissionless, because all the things you've just said make sense to anyone who's in business. But I feel like for all the crypto bros, crypto gals, and crypto people, they're like, Kyle, you're killing the vibe, dude. You're killing the vibe. We're all at a frat party, and you're there saying, like, someone, you're there like, hey, there's a 66% chance someone's going to throw up from drinking too much beer. You feel what I'm saying?
Right,
And so
exactly.
how are they picking, like, how are you received when you come across with this? Because I think you're totally right. And for institutional money and bigger money to come in, if you're looking at, national treasuries to come in, there needs to be, I think, a little bit more legalese and insurance and different parameters around the space. But at the same time, I think one of the things that's cool about crypto or Web3 is people are like, oh, I'm just going to build my NFT project and throw it up. No one's thinking, should I insure this? If I create a DAO, do I need to have insurance? So how do you engage with that, and how do they receive you? Because it's almost like you're the parent coming into the frat party.
That is definitely how I thought I was going to be received, to be honest with you. When I first came to this idea of really taking it seriously, using my knowledge base of traditional insurances that I do daily in the obviously very unique position I have to work for a publicly traded company that is extremely forward thinking and really appreciates solutions for niches, I needed to ask the community. Ultimately, I had to ask the builders, and I had to ask the founders, and I had to ask people who are already considered influencers, if not Web3 thought leaders. And the reaction I got was, you're the only person talking about this, and it makes a lot of sense. We want to learn more. So when I got the opportunity to go down to Permissionless, To your point, I kind of felt like a dad. I was the only person there in a suit for all 4 days. So everywhere I went, they knew me as the guy in the suit. Who is the guy in the suit? Everyone's wearing Log Me shirts. People had obviously brand new shirts that were being released. There was an incredible protocol that did an entire take on Back to the Future. They even replicated the Back to the Future car. They won best booth that particular convention, and it was incredible. And so people had those brand new shirts as well. As I was walking around and meeting individuals, everyone wanted to learn more. They were interested. They understand the vulnerabilities. And I think while I assume there was resistance, the reality is they know that they already have the treasury for that reason. They're already using their treasury as a form of adjacent insurance. If that's the case, all they're really doing is just using their savings account to pay for vulnerabilities that they're not necessarily covering. So when I went around, I got to meet some of the most incredible minds there. An individual named Miles Fuller with TaxBit. I got to meet Chris Sardonis from Reddit. I got to meet Josh Rosenthal. He is a very influential speaker that really talked about the entire idea of this being the crypto renaissance and really just a financial renaissance. So ultimately, I got the opportunity to walk and meet. I probably met about 150 different projects there, whether it was MetaMask Institutional, got the opportunity to meet with Consensus, got the opportunity to meet some people from Aave. And every single time the feedback was, we want to learn more. Any layer of security and actual layer of capital that we can use in between our losses and our treasury is more than appreciated. So then I got the opportunity to use some of my networking skills and my creative ability to plug into my buddy Chris to get onto the Ripple yacht. It was very incredible time. Got to meet some of the smartest minds that I've really ever met in terms of what's going on with Ripple and their ability to believe in their protocol and what they've created so much. They were one of the few who's ever gone up against the SEC and started winning their cases. They were proving their cases right, that they were not indeed securities. And I thought it was amazing. And that deep conversation was understood by even the end users who were there as fans. As you could imagine, these blockchain conventions, it's a mix of the industry with true rabid fans that have, maybe they're whales, maybe they've made a lot of money in their selections, whether it was DeFi or an NFT mint that 100x'd and they chose to flip it. However they've done it, they've done decent financially, and they're huge fans of the space. They were receptive of it too, and they even understood the concept of what Ripple was going through, which I found very unique in our space. If you think in terms of a financial advisor, most people who talk to individuals that are looking for financial advice, they don't understand finance. The unique thing about right now where we're at in Web3 and blockchain and decentralization is most people understand decentralization finance because that's why they're already participating in it. They understand the functions of what the ledger system's doing. They understand how to take this concept of a non-fungible token and turn it into utility and turn it into a real life experience and actually build a community beyond that. And so it all intertwines with insurance, and their idea was insurance could be the backbone. It could be the bridge between traditional legacy finance and new decentralized finance. Because when they have the option to opt into the insurance, instead of making it mandated, they should opt in to this option of insurance. And if they do that, well, they're choosing a layer of centralization because, of course, I have to have oversight. My reinsurers have to have oversight. And we want that. You wouldn't want me to sell you insurance that nobody's actually making sure that the companies that say that they have your financial back in terms of these limits, no one's checking to see if there's actually money in their treasury. No, you wouldn't want to sign up for a product like that. So ultimately, it's a perfect medium of giving some layer of centralization and authority from whether it's FDIC or the government's overseeing, if we're talking about individually something happening in America versus the UN overseeing these particular products. It gives that arm to the government so that they can have a hold of the industry without actually getting a hold of the ethos of the industry. Let them be in control of the safety net, And honestly, I think bigger projects, enterprise level projects, are going to immediately inherently want to adopt the insurance because ultimately that's a way for them to grow even faster. And they're familiar with the need of insurance from the TradFi experience that they've had all this time in the legacy industry. And so that's really what I think I got as feedback in that particular market. And of course, I have to keep in mind it was a huge bull market at that moment. We hadn't hit the bear market yet. Bitcoin was 35,000. Ethereum, I want to say it was almost 3,500. It must have been around 3,200 right then, because this was about May. Now, flash forward, maybe 2.5 months later, I get the opportunity to go to NFT NYC. Completely different market. You'd think it would be a different ethos. Celsius just got caught, 90% down. Subpoenas, lawsuits flying everywhere. Duquan, couldn't find him. So we didn't know what the reception was going to be at NFT NYC, but we had a feeling the builders were still there to build. We had a feeling that the audience was still there to support their communities. And what you know it, that's exactly what it was. There were 2 times the amount of people, and permissionless was big. I probably met, or at least heard, that the attendance was about 10,000. There's 15 to 20,000 people here in New York. Now, of course, New York City has a lot of locals. It's a much bigger metropolis than West Palm Beach. So I have to keep that into consideration. But in totality, it was double the volume in the worst market that the crypto and blockchain had ever seen in the history of this segment. And yet everyone was excited. No one was downtrodden. There wasn't people there saying, I feel like this industry scammed me. Why are you guys doing this? Really, the only one thing that I saw, and I believe that it was paid, I cannot verify if it was not paid or paid, but they did have a protest the first day with a bunch of people called anti-meta maskers. We thought it was funny. We think it was probably a joke. We're not sure if it was serious or not, but they did a march around the Marriott marquee that day with a whole bunch of signs that say we're anti-meta mask and, DeFi this or DeFi that. It was fairly humorous, but I don't think they were being too serious. And then I got the opportunity to see the stages. Grace Gong spoke. Incredible. We got to watch Wall Street Bets talk a little bit about where they're going to bring their NFT mint and vision. We got to see incredible new projects. So people specifically, I'll give them a shout out, Omni Horse. They're tokenizing race horses. We got to meet with individuals that are tokenizing yachts, Fathom Yacht Club. Got to meet with individuals who are using stable coins that are backed with bushels of wheat. I also met ones that are using stable coins that are backed with REITs. So now we're seeing TradFi completely intertwining with DeFi. How do you use a stable coin to back it with real estate interest and trust? What a merger of 2 completely different segments, seeing the value in each other and being able to offset the tokenization with a real life asset. And it was mind-blowing, and everyone was receptive. Everyone was even more interested in the insurance angle because now the proof was there. We're looking around us, we're seeing lawsuit left and right. We're seeing declines of value left and right. And ultimately, we're seeing communities still wanting these projects being built. So the realization was what we're building isn't going away. So then how do we pivot to solidify the industry? Because we haven't created a fad here. We know we've created some staying power, but what else can be built upon what we're building, layer 1 to layer 2, to give it more stratospheric staying power? My personal opinion, it's got to be the insurance. It must be some layer of capital that's going to bring that safety net.
You've just said a billion things, and I absolutely love all of them. And I'm trying to figure out where I want to jump off for, where I want to take the conversation. One of the things I do want to call it is I know that your work computer has been buzzing, but that just means that you're super busy. And whether it's after this podcast or in the next 6 months or in the next year, I have a feeling that almost everyone in and around NFTs and crypto is probably going to know who you are. Because from what I can tell, you're one of the only people I've seen, at least on Twitter or LinkedIn, which are, I think, the places where all the chatter happens, where you're saying exactly what you're just saying. Hey, the thing we're building, it's probably not going to go away. So if it's not going to go away, how do we build it better? And how we build it better is with insurance. And it's got me thinking that in the future, on OpenSea, or if you're going to hop into a DAO, or if you're going to be part of liquidity pool, anything with DeFi, I can see a future, and I want your estimate on how, how soon that's going to happen. Where when you look at a project, you're going to be one of the bigger questions is not just who are the founders, not just what's the utility. It's going to be, hey, is this insured or not? So if it goes belly up, I get my money back. It's kind of like the new blue check in some sense. How far away do you think we are from that with, on a marketplace like Rarible or OpenSea or, anything with DeFi, DAOs, anything decentralized?
I think we're really not that far off with that concept. It really could take maybe, I'd say 6 to 12 months realistically, if we build it as fast as possible. But that's going to come with data sharing. That's going to come with the biggest enterprise protocols in the entire world sharing this data with us so that we can get it built. But the concept really would be the individual projects are going to ensure their individual projects. It's not going to be a one size fit all where it's not going to be like where you go to shop for car insurance, to put it bluntly. You're not going to be able to be a wallet holder and then say, okay, I've got my insurance for my wallet, and now I'm buying on both Solana as well as Ethereum, and I hold a bunch of Bitcoin inside my Coinbase wallet. Now, short of Coinbase offering their own version of insurance for their specific wallet, I don't think that's really the solution. I think projects need to offer insurance within their own sphere, within their own project, because that is keeping the idea of decentralization. You've created something that is within your server space. So we need to be protecting the things that are occurring in your server space. There's no way to police the entire internet. It's not happening. We're not going to be able to police, prevent, stop bad actors, build enough products. There's not enough cybersecurity firms in the entire world. Even if they put themselves together, could they stop everything that can happen on the internet? Absolutely not. So that's why I think the approach really has to come from within. It has to be the project makers understanding that they need to believe in their vision so much that we give them the ability to backstop their own projects internally and create a product that allows them to issue their users protection for that particular asset. So perfect example, if Yuga Labs were to offer protection for just Bored Apes, then if you were to engage with Goblin Town's DAO will need to be able to protect Goblin Town. I don't think it's going to work. It's too dangerous to have me having one particular policy that protects for all my different NFTs. It's got to be siloed like that. Because think about it. If it was that simple, well, then really the answer would be we protect Discord, we protect OpenSea, we protect any other marketplace, and then the problem's solved in essence, right? But I don't think that's the way it's going to work. Let's imagine we install it that way. Then the next week, somebody gets on a different version of Discord 3.0, and their wallet gets emptied. And they're like, well, my product didn't work. What you sold me didn't work. I mean, it's already stolen again. So that's why I think it really has to be individualized. And for that matter, that's what they're already doing. That's literally what they're already currently doing. They're using their treasuries to pay out losses. They're self-insuring already. They just don't know it. And also, they don't have structure to it. There's no defined what counts, what doesn't, how do I replace? And that's why the government had to step in and force Voyager's hand. If they had some sort of template there, maybe their cost would have been half that number. But because there was no template there, there's no precedent set with what happened with Voyager. The government came down and said, you know what? You need to fully reimburse anyone who's ever invested in you. Period. We think you're a scam. We don't understand what you are. But in our opinion, you've done something so egregious that you need to refund the purchase price of your products, even though they're not at that value. You've never heard that in any other arena. You've never bought a pair of Jordans, felt like the tongue split too early 4 years later, and you went back to Nike and they reimbursed you for the $150 pair of shoes. In this instance, because there's no precedent, that's happening. So we got to work quickly and swiftly with our project makers to help them understand that dynamic is at play, and then put together a real more solidified plan to protecting themselves with the capital they already have. And that comes into insurance. And hopefully we're going to set it up where the insurance carriers are open to the idea of allowing them to insure their base community down the road.
with the insurance, the way it's traditionally done, there's a certain amount of products. Like I think mentioning car insurance is great because anyone who's had a car or ever driven a car, you're gonna have to deal with insurance. Even if you've only ever driven a rental car, insurance is half the conversation when you're at the desk.
Exactly.
So that seems super simple, right? Like, okay, this car is this old. I'm this good of a driver. We're going to put those together. The algorithm, the equation will tell us what the premium is going to be for a day. Great. In the future, which is now, right? In Web3, is Web3 going to completely change the way we think about insurance on some sense? At the end, I think it's all just mitigated risk and analyzing the risk. But is there something about Web3 that where the rules have changed so that way the game changes? And the example would be, I'm not sure how into soccer you are, but in soccer there's offsides. But when soccer first started, way back in England in like 1870 or whatever it was, they started 15 on 15. It was like 150 yards, 15 players versus 15. It was 150 yards, and there was no offsides. Now it's 11 on 11, about 110 yards, and there's very strict offsides. So as the rules have changed, the rules change the game. So because the Web3 is built on different rules and more of a decentralized nature, is that going to change the way the players within the game act, and therefore the insurance apparatus, which is kind of a dome over all of this, is it going to have to change? Point being, in 100 years, when Kyle Butler Jr. is sitting on a podcast, he's going to be like, yeah, I remember my granddaddy came up with all this stuff, and he's the granddaddy, the grandfather of insurance in Web3. He couldn't have foreseen where we are now. I'm not sure if I'm making sense,
You
but
are.
what ways are we going to have to mold to this new world that we didn't in TradFi or the legacy system?
I think any intermediary system is about to change tremendously because of the concept of blockchain, not just the concept, the functionality of what's really going on here. The ability to do underwriting from the onset and let the smart contract self confirm itself and then self complete itself. Obviously, on the personal realm, I can tell you, I can't get into specifics, but I do know that there are companies size and stature of mine, if not bigger, that really truly want to harness this technology for specifically auto insurance and sharing the data of losses amongst the multiple different carriers to make it a streamline switch from Geico to Allstate to State Farm back over to the General. If you've gotten in some trouble, you have a lot of accidents, you got to go through your state. Here in Florida, we call it Citizens. I don't know. The client could be anywhere in the United States. There's a version of state insurance for you. If you've gotten 14 car accidents and 200 miles over the speed limit 4 times in a row, it's going to be difficult for you to obtain that. I think really the difference maker, what we're really trying to get at is what is really going to be the catalyst. And it's of course going to be the digital ID. I mean, once we integrate having our PHI, our PII, our PCI all in one particular silo, whether it is anonymous or directly attributed to our Ethereum name service, ultimately that is what's going to be the catalyst to change all of these interactions. It's the ability to have all of your personal data, financial data, health data in one particular silo that can be verified, tracked, and transmitted through health insurance, to car insurance, to life insurance, to property insurance, to your business's insurance. And that's really the catalyst. And I think all of the brands, as we're seeing big financial adoption, we see KPMG spending $155 million to train their staff. These are tax auditors, by the way, to train their staff on the metaverse. I think the big traditional systems are seeing what this particular technology has the capability of doing, and they're trying to get on the forefront of education to their staff before making the commercial moves that we as citizens are going to inherently adopt and utilize. And that really, for me, is going to be the catalyst. And once we have that kind of set in stone where people are familiar with Web3, their wallet, what custody really means, what it means to own your personal data and be willing to share it in a very transparent way with your doctor versus your insurance broker versus your teacher for that matter, or meeting a teacher for the first time, that is where it's going to be revolutionized. And I think at that point, there might not be that much of a need for individuals like me, for individuals like title companies. Definitely with the real estate shifting the way it is and the automatic, once again, the self-fulfilling contracts, there's going to be a limited need for individuals who are overseeing transactions like that. But what it's going to do is it's going to create an entire new ethosphere. And that's where you describe my grandchild, who is going to describe things that we can't even fathom right now. I can't tell you what the future is going to be because it's so radically different, because we're creating new jobs. We're creating entire new environments and worlds. Like, I have no idea what mercantile programs are going to be installed through these villages that I'm seeing in the metaverse. But I can tell you, people are going to want it. People are going to be entertained, and money will be well spent in those realms. No clue what they look like yet, but I do know that people want it already. And as this technology gets more embraced, the creative jobs that are going to come from this technology, they're going to be fulfilling, and people are going to be spending money towards those jobs. So that would be my answer on what I think is going to change. There's not really a specific. It's really the ethos, what this technology is doing for all of us.
Absolutely. To finish up and to give you a chance to kind of shout out where people can reach you if they are interested. I've had guys on episode 32, they have a full Web3 kind of consulting development team,
Love that.
and they probably need to start to introduce some of these concepts. So if people do want to reach out to you, where's the best place? We met through LinkedIn. I'm feeling like you're active on Twitter. I'm not really sure, but if you want to go out and shout out all your social media and maybe BKS's website and other stuff, that'd be great.
Absolutely. First off, we can look at BKS or Baldwin Risk Partners, www.bks-partners.com. That's BKS Partners. You're looking for the publicly traded company, baldwinriskpartners.com or brp.com. And then if you're looking for me individually, you can follow me on Twitter at KyleB92M. And then on LinkedIn, I am, once again, Kyle B92M. If you're trying to get a hold of me directly, there are ways of finding me through that website to send me a direct email. But I think the best way to really truly get a hold of me, find me on LinkedIn, send me a DM, send a connection. I will immediately provide you my personal information, cell phone number, actual tailored email, so that we can get a deeper conversation. We can share data with each other and work to see if I can provide a solution, or maybe my network can provide a solution. More than just asking me about insurance, learning how to mitigate risk is asking me who I know that I can put you in touch with that can fulfill a need that insurance doesn't fill. Insurance is the last line of defense. Honestly, it's capital that you don't want used. So up until then, it's my job to surround myself with vendors and solution artists that are providing the best, what I would call, protection around you before you get to this last line of defense. And that's why I said that would be a reason to reach out, other than just the idea of insurance. It's to find out, well, where should I turn? Who do you know? Who do you know that's doing smart contract reviews? Who do you know that builds smart contracts, Kyle? I have some people in my back pocket that I can introduce you to and help you do your due diligence as we go to build this new world. 30 days in Web3 is an entire year in any other industry. So we have to take that into account. We really do need to understand that this technology is growing exponentially. And if that's the case, well, then learning what vendors can help you secure your exponential growth is that much more vital. 7 months from now, maybe you've built something that can't be undone on WordPress that needed to be moved to Amazon Web Service. And no one pointed out that by the time you got to where you were going, simply the capacity was going to fail you. You're not going to be able to keep the volume of traffic on your marketplace by keeping it on WordPress. But if you don't have people surrounding you to tell you that, you're never going to know until it crashes. And then you're going to be sitting there going, okay, we went from 4 ETH down to 0.002. What do we do here, guys? Call someone like us.
Perfect. I will add in all those links in the
Yes,
show
sir.
notes. And thank you so much for hopping on today. And I'm sure I'll see you soon on Not Crypto Bros.
Absolutely. We'll get to Not Crypto Bros, and then I look forward to partner with you in the future. And we'll bring some more lighthearted humor content that is much more dedicated to just Web3, giving out concepts, a little less boring and rigid like insurance. Let's get into the flexibility of Stretch Crypto Armstrong.
Let's do it. Thanks.
Thank you so much, Jared. I truly appreciate it, brother. Hope you have a great day.
Thanks for listening to this episode, and be sure to find Kyle on Twitter and LinkedIn via the links left in this episode's show notes. And reach out if you have any questions about all things insurance in Web 2, Web 3, and even with crypto. As always, please follow us on social media at More Than Blockchain, and check out our website at morethanblockchain.xyz for more info on the podcast. No matter where you're listening to the podcast, please subscribe and feel free to share the episode with a friend, family member, or work colleague who you think would find value in learning about how insurance will improve Web3 and crypto. Thanks again for checking out More Than Blockchain, and I'll see you next time.